Hey everyone, it's Richard. You're watching The Plain Bagel. Major news circulating in the finance space online this past Friday, as we got the breaking headline from Finance Twitter, or Finance X, whatever we're calling it these days, that Federal Reserve Chair Jerome Powell had abandoned reason for madness and would be throwing away America's 2% inflation target rate. With during a keynote speech at the annual Jackson Hole Symposium, the Fed chair caving to pressure and turning dovish, shifting from an inflation targeting regime to a focus on employment, telling the boys to put on the space helmets because we're firing up the money printers again. A shocking update that many were quick to share and lament online, warning that this would pave the way for higher inflation, possibly even stagflation, and the spiraling collapse of the US dollar. All of which incredibly concerning if any of it were real. But turns out this was just some wild misinformation we saw really take flight over this weekend, stemming from a pretty severe misinterpretation of what was actually said at this keynote speech. You see, on Friday at this annual event hosted by the Kansas City Federal Reserve Bank, we had this highly anticipated speech from the Federal Reserve Chair Jerome Powell, where he was expected to update people on his views on the central bank's policy moving forward. And not long after the event, we had this unsourced screenshot start circulating online, seemingly suggesting that the Fed had made this drastic move to abandon its 2% inflation target. And for a lot of big profiles, it's proof enough to start raising the alarm and spreading the word that the Federal Reserve had started the path to hyperinflation. So to get to the bottom of this, I decided to do the unthinkable, to venture where no one else dared to. I read the 20-minute speech transcript. And what's crazy is that while this bullet point technically isn't incorrect, it's just being wildly misinterpreted. And far from abandoning the 2% target, it's actually reaffirmed in many points throughout the speech. There were indicators that the bank might be shifting its policy towards something that eases its current restrictive policies, which is why we did see markets and the crypto market jump on Friday. But far from whatever we saw kind of being claimed online. And if you want to see the speeches for yourself, I'll include links in the description down below to the transcript as well as the live stream of the speech. But to quickly summarize it here, essentially we have Jerome Powell highlighting that while the US is currently experiencing relatively tame inflation and unemployment rates, things are a little jittery, if not curious, to quote the actual word he used. With the US seeing both supply and demand for employment falling and GDP growth slowing, indicating that while, yes, unemployment was still near historical lows, there were risks around that, something highlighted by the massive downward revision to the labor data we saw on the July report. With tariffs, decreased immigration, and changes in government tax policies, spending, and regulations being key factors impacting economic growth and productivity in the US. He also highlighted that inflation faced upside risk because of tariffs, which, even though they should just lead to this sort of one-time impact, could translate into a longer-term, more persistent high inflation rate, which was something the bank would need to monitor for. However, with the bank's policy being in restrictive territory and employment facing these downward pressures, quote, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. And that line was probably the biggest takeaway from the speech. As you are probably aware, the Federal Reserve has this dual mandate of both ensuring price stability and trying to achieve maximum employment. And in the speech, it was more or less being highlighted that while the Federal Reserve saw risks around inflation and intended to keep things around 2%, that it was also seeing this weakness in employment and didn't want to basically neglect this data, and that it would consider how information developed moving forward in deciding whether to make a change. But then, Richard, you might ask, where did this idea that the Federal Reserve would be abandoning its target come from? Well, again, that seems to stem from this widely shared screenshot of a unsourced bullet point that turns out to come from this Bloomberg article, with Bloomberg being a fairly reputable business journal. And if you read the quote, it does sound like the Federal Reserve is moving away from targeting inflation in favor of focusing on employment. But if you look ever so closely, you'll see the word average in there, which is playing a monumental role in changing the meaning of this bullet point here. You see, as part of the speech, Powell provided an update to the Federal Reserve's statement on longer run goals and monetary policy strategy, which is essentially just a public statement highlighting the Fed's framework for managing its dual mandate of, again, promoting maximum employment and maintaining stable prices. And Powell announced that with this update to the statement, the bank would be moving away from its makeup strategy around inflation. You see, after the 2008 financial crisis, the US had this weird situation where it was dealing with both very low interest rates and low inflation. While that might sound like a kind of best case scenario, it did present a unique challenge to the central bank, because if the US economy suddenly would need monetary stimulus, there wasn't anywhere further that rates could go. They were already near their effective lower bound, which limited their options for kind of intervening. So in 2020, the bank changed its approach with inflation targeting to focus instead on a long-term average inflation rate, meaning that if there was, say, a 2 or 3 year period where inflation was below 2%, they would allow inflation to reach above 2% in the following years, so that over the long term, it would reach that 2% average inflation rate. However, with the pandemic and the surging inflation we saw during that period, it became evident how easily inflation can get out of hand if it's allowed to creep above this target, even with what were assumed to be transitory pressures. So the big update that we saw with this 2025 speech is that the Federal Reserve will be abandoning its long-term average inflation target of 2%, this so-called makeup strategy, and just reverting to its strategy from before the 2020 update of just targeting 2% every year. That's it. That's the big update that led to all this misinformation. And the bullet point is technically correct because the Fed is abandoning its average inflation makeup strategy and is putting more focus on employment. But the crux of the speech was that in this environment where you have sort of these factors pulling in different directions, that they would try to take a balanced approach. So while I agree that the bullet point in isolation is very easy to misunderstand and maybe even be borderline misleading by itself, you can see that what was circulating was just flat out wrong. Now, I will highlight that the speech was seen as a meaningful shift in the bank's rhetoric up until this point. We had recently heard that members of the FOMC were in favor of holding rates steady, lowering the chance of a September rate cut. And Jerome Powell had highlighted that until the tariff situation stabilized, there wasn't much motivation to start lowering rates. But with the speech, the Fed has now opened the door to a possible pivot, highlighting, hey, we don't want to kill the economy with rates that are too high, given the risks that we face. So there is room for a pivot moving forward. And there is a lot of pressure on the Federal Reserve to do just that, outside of the literal pressure coming from Donald Trump himself. We have also seen liquidity in the financial system decrease. You may have also seen the alarm bell tweet circulating around the so-called reverse repo facility being drained. That was going to be the topic of this video before the weekend, but just to quickly touch on that, doesn't mean that there's no longer repo money available, but it is a sign of financial institutions being less willing to lend out their money. And with the central bank also carrying out quantitative tightening, that's also pressure on liquidity. As the bonds that the central bank bought mature and don't get kind of rolled over, that leads to money being pulled out of the system, which again can be quite restrictive. But importantly, the Federal Reserve hasn't committed to easing monetary policy yet. Yes, there was again this change in tone of the speech, but it effectively amounted to, hey, we're going to see what data comes out and be open to the idea of shifting based on how things update in the future. But there wasn't any commitment to a rate cut in the near term. And even if there was a rate cut, rates could still remain above that neutral level, meaning they'd still be restrictive, since that neutral rate is the point at which interest rates are neither stimulating nor depressing the economy. And we've covered on this channel before how rate cuts don't inherently lead to higher market returns, since they're usually in response to other economic factors that are simultaneously depressing economic activity. So while not all the discussion around the Friday speech was misinformation, there were people being critical of this rhetoric shift, highlighting that it's too early for the Federal Reserve to consider switching to rate cuts and risking the stagflation. But even there, it's worth acknowledging that nothing was committed to with the speech. We don't for sure have a rate cut coming in September, even with this change of tone. And with Federal Reserve members having previously highlighted the need to tolerate periods of liquidity friction to normalize Fed involvement in the markets, it's far less certain exactly how far the bank would go with stimulus measures, whether that would involve QE or other interventions, if it does take that route. Anyway, that's more or less the story and all I wanted to say about it. Of course, people make mistakes. It's easy to see how this bullet point was misinterpreted, but it's also not the first time we've had this sort of misinformation wave in the finance space about some apocalyptic dollar headline that turned out to be fake. You might remember the end of the petrodollar agreement, this fabled document that was set to expire and pose the end of the US dollar. Turned out that the actual agreement that people seem to be referencing had nothing to do with the petrodollar arrangement. It's frustrating because all this could be avoided if people just took the 10 minutes to read the source material, the primary document that they're spewing all these opinions on. So if nothing else, hopefully it serves as a reminder that on social media, you got to be careful because these types of posts, especially in the finance space, can influence people's investment decisions. And whether it's my own content or someone else you follow on YouTube, Twitter, whatever it is, just remember that substantial claims require substantial evidence, right? Not some obscure screenshot of someone else's summary of what allegedly happened. Anyway, thanks for joining me today, and as always, be safe out there.